Hi, I'm Linda Eedes, and this is an update for the Global Felxible Fund for the fourth quarter of 2017. So looking at the performance of the Global Felxible Fund towards the end of last year, if you actually look at the quarterly return, it was slightly negative. And the reason for that was one that we should actually be personally quite happy about, which is that the rand strengthened by 10%. Now, you might remember that the Global Felxible Fund is a worldwide multi-asset fund, which means that we can invest locally or globally wherever we see value. And currently the portfolio is split pretty evenly between South African assets and global assets, or non-rand denominated assets. And whilst those assets actually were up sort of close to 3% in dollar terms, obviously translating that back into rands, you get a negative number for that portion of the portfolio. And the South African equity portion of the portfolio was also up slightly during the quarter, sort of closer to about 3%. The major driver behind the returns locally were the banks. Obviously following a lot of negative sentiment surrounding sort of the Nenegate saga towards the end of 2015, surrounding credit downgrades, banks have obviously taken a massive knock. That's really sort of quite a barometer of the nation's health. And with things kind of turning a little bit in the right direction, that sentiment has also turned quite strongly. And we hold First Rand and Standard Bank in the portfolio, so you'll see them in the top 10 holdings. And both of those stocks were up sort of over 20% during the quarter. So how quickly things can turn just on the back of sentiment is quite an interesting phenomenon in markets. But looking at the sort of structure of the portfolio, I think another thing which is interesting about the fourth quarter is that we actually sold out of our government bond position. We had a small government bond position, which sort of translated into about a 4.5% position in bonds in the portfolio as a whole. And yields, although on the front end of the curve, interest rates rose slightly, if you look sort of in the middle of the yield curve, there really wasn't much move. And we just feel that from a sort of credit perspective, we think that there has been a deterioration in sort of the sovereign ability of South Africa to actually repay, or the willingness as well to repay its debt. And we don't think that that's really sort of been reflected in the yields in the market yet. So we're feeling a little bit uncomfortable about where yields are relative to the risk. And so we decided to actually sell out of that bond position in the Global Felxible portfolio. Looking at sort of the global portion of the fund first, before I move on to the sort of domestic side of things. If you look at the global portion of the fund, we did have some nice performance coming through from businesses like Tesco. It had another good quarter on the back of sort of the turnaround story coming through there. Quite an interesting business because the share price has sort of lagged what's been happening on the ground for that business, and I think all of a sudden sort of the market's starting to now buy into the fact that this business is on the mend. In contrast to Next, interestingly, we initiated a small position in Next PLC, which is of course the UK's biggest clothing retailer, and they actually came under a little bit of pressure towards the end of last year, mostly as a result of a negative trading update, which sort of was very much around the fact that they had unseasonably warm weather in the UK, which saw a lot of Christmas shoppers or pre-Christmas shoppers actually doing other things besides shopping on the high street. So that sort of had a little bit of an impact down, but that was offset quite significantly by the positive impact of our commodity exposure. We still hold some Anglos, a little bit of Billiton. We saw industrial metal prices rising across the board really, and that was on the back of a sort of synchronized global growth story that we're seeing sort of emerging. The feeling that actually the global economy is going to be okay, and commodities have continued to rise sort of off the back of that. And then also our energy producers such as Inpex and BP were also up quite strongly during the quarter. You saw oil prices actually going sort of over $66 a barrel, and that obviously was very positive for those stocks. Looking at the local side of the portfolio, what we're seeing is very much that continuation of South Africa Incorporated in terms of where we're focused. We sort of have our exposure predominantly in those kind of core, more quality South African oriented businesses. Of course, that's sort of the part of the market that has been under pressure over the last few years, but things seem to be turning in the right direction for some of those businesses. And interestingly, we've started to take a closer look at some of the sort of more global South African businesses, or those that have sort of a global component, such as MediClinic, which we introduced into the portfolio in the fourth quarter of last year. So a business that's come under immense pressure because of some of their sort of offshore businesses, and we feel that now, is the time to actually start taking a bit of a nibble. So looking at the portfolio, it's nicely evenly split actually between sort of the local side of things, with a strong South African flavor there, and global businesses, which look quite different, even though the global portion has performed quite well and has kept up with this rally in global markets in general. The global portion is made up of very different stocks. So I think that should be of comfort, because if you actually just look at the makeup of that, it does also have quite a chunk of cash, global cash, in the sort of offshore portion of the portfolio. And that should see our investors in good stead if we do see some kind of a pullback in those stocks which have basically pushed the market to such high levels. So overall, we're very comfortable with the global flexible portfolio. It's got nice exposure across geographies, across various industries, no sort of over concentration to one particular area, and all the businesses that we've invested in have two things in common. They are quality businesses, and they happen to be undervalued at current prices.